Selling your business is one of the most significant financial decisions you'll ever make. For many owners, their business represents decades of hard work, countless sacrifices, and the majority of their net worth. It's not just a transaction, it's the culmination of your entrepreneurial journey and the foundation of your next chapter. But selling a business in Australia is a complex process that requires careful planning, strategic execution, and professional guidance. Done poorly, you could leave hundreds of thousands of dollars on the table, or worse, end up in a failed transaction after months of effort and stress. Today, we're walking through the complete process of how to sell a business in Australia, from the moment you start thinking about selling, all the way through to successful settlement and handover. Whether you're planning to retire, pursue new opportunities, or simply cash in on the value you've built, this guide will help you maximize your outcome and navigate the journey with confidence. The best time to prepare your business for sale is actually years before you plan to sell. But even if your timeline is shorter, there are critical steps you can take to maximize your sale price and attract quality buyers. First, get your financial records in impeccable order. Buyers and their advisors will scrutinize your financials intensely. Your profit and loss statements, balance sheets, and cash flow statements should be professionally prepared, ideally by a qualified accountant. They should be consistent, clear, and complete for at least the past 3 years. If you've been running cash through the business without declaring it, or claiming personal expenses as business costs, stop immediately. These practices don't just create tax issues, they make it nearly impossible to sell your business at fair value because buyers can't trust your numbers. You need at least 12 to 24 months of clean, accurate financials to demonstrate true business performance. Document all your systems and processes. Many small business owners carry critical knowledge in their heads: supplier relationships, operational procedures, customer preferences, problem-solving techniques. This makes the business dependent on you personally, which reduces its value to a buyer. Create operations manuals, document workflows, record supplier and customer information systematically. The goal is to make your business transferable. A buyer should be able to step in and operate successfully without needing you to hold their hand for months. The more systematized and documented your business, the higher the value and the faster you can exit. Address any deferred maintenance or necessary improvements. If equipment needs repairs or replacement, deal with it now. If the premises need a fresh coat of paint or updated fixtures, invest in it. First impressions matter enormously. When potential buyers walk through your business, you want them to see a well-maintained, professional operation, not a tired, neglected one. However, be strategic about improvements. Focus on things that directly impact operations or curb appeal. Don't overcapitalize by installing expensive upgrades you won't recoup in the sale price. Strengthen your management team and reduce owner dependency. If the business can run successfully without you being there every day, it's worth significantly more. Can you take a 2-week holiday and come back to find everything running smoothly? If not, start developing your team's capabilities and delegating critical functions. Lock in key employees with retention agreements if possible. Buyers worry about staff departures after acquisition. If you can provide assurance that critical employees will stay through the transition, that reduces buyer risk and increases value. Review and strengthen customer and supplier contracts. Long-term contracts provide revenue certainty that buyers value highly. If you operate on informal arrangements or month-to-month agreements, try to formalize them into longer-term contracts before selling. This demonstrates business stability and reduces perceived risk. Finally, clean up your corporate structure and legal compliance. Ensure all licenses and permits are current. Resolve any outstanding legal issues, disputes, or compliance matters. Make sure your business entity is properly structured with up-to-date documentation. These issues will emerge during due diligence anyway. Better to address them proactively when you have time, rather than under pressure during a transaction. One of the biggest mistakes sellers make is having unrealistic expectations about their business value. Emotional attachment and years of hard work don't translate directly into sale price. The market determines value based on objective financial performance and buyer demand. Engage a qualified business valuer or experienced broker to conduct a formal valuation. This typically costs between $2,000 and $10,000, depending on business complexity, but it's money well spent. A professional valuation gives you a realistic price expectation and provides credibility when you go to market. In Australia, small to medium businesses are typically valued using a multiple of earnings. The most common method is applying a multiple to your sustainable discretionary earnings. That's your profit before tax, plus your owner salary and benefits, plus interest and depreciation, adjusted for one-off expenses. The multiple applied varies significantly by industry. Service businesses with recurring revenue might command 2.5 to 4 times SDE. Retail businesses might be 1.5 to 2.5 times SDE. Manufacturing businesses with significant plant and equipment might use 2 to 3 times EBITDA plus asset values. Location-dependent businesses like cafes or restaurants often trade at 2 to 3 times SDE. Several factors influence where your business falls within these ranges. Strong, consistent revenue growth increases value. Diversified customer base reduces risk. Long-term contracts or recurring revenue provide certainty. Well-documented systems reduce buyer risk. Low owner dependency makes transition easier. Favorable lease terms protect the business foundation. Conversely, factors that depress value include declining revenue trends, customer concentration, where a few clients represent most revenue, short lease terms or uncertain lease renewal, high owner dependency where the business revolves around your personal skills or relationships, regulatory risks or compliance issues, deferred maintenance or equipment near end of life, and intense competition or challenging market conditions. Understand that your asking price and actual sale price often differ. It's common to list at the higher end of valuation range and negotiate down. However, overpricing significantly beyond market value will cause your business to sit on the market for months, which itself becomes a red flag to buyers. Stale listings suggest problems. Your valuer should provide a range, not a single number. For example, $450,000 to $550,000 based on current market conditions. This range helps you set realistic expectations while giving room for negotiation. Also, consider the structure of the deal, not just the headline price. Sometimes accepting a slightly lower price with better terms, larger deposit, faster settlement, vendor finance component, solid restraint of trade, provides better overall outcome than a higher price with difficult conditions or risky buyer. You have 3 main options for selling your business in Australia. Sell it yourself privately, use a business broker, or work with a mergers and acquisitions advisor for larger transactions. Selling privately saves broker commission, typically 5 to 10% of sale price, but requires significant time, expertise, and emotional resilience. You'll need to value the business, prepare marketing materials, advertise the opportunity, screen inquiries, manage confidentiality, qualify buyers financially, negotiate offers, coordinate due diligence, and handle legal and accounting requirements. For experienced business people selling a smaller, straightforward business to a known buyer, private sale can work, but most sellers underestimate the complexity and time required. It's also emotionally challenging to negotiate directly with buyers while running your business and maintaining confidentiality. Using a business broker is the most common approach for businesses valued under $5 million. A good broker handles the entire process: valuation, preparing the information memorandum, marketing across multiple channels, screening and qualifying buyers, managing confidentiality, negotiating on your behalf, and coordinating the transaction through to settlement. Yes, you pay commission, but professional brokers often achieve higher sale prices that more than offset their fees. They also save you enormous amounts of time and stress. You can continue focusing on running the business and maintaining performance, which is crucial for achieving the best outcome. When choosing a broker, look for several qualities: relevant industry experience, they should know your sector, proven track record, ask for recent comparable sales, professional licensing, verify they hold required credentials, clear marketing strategy, how will they find buyers, good communication, you need regular updates, transparent fee structure, understand all costs upfront, interview at least 3 brokers before deciding, ask them to present their approach, explain their marketing strategy, and provide references from recent sellers. Don't automatically choose the broker who suggests the highest price. Often that's just a tactic to win your listing. Choose based on professionalism, strategy, and track record. For larger businesses above $5 million, or those seeking strategic buyers, consider M&A advisors. They have access to institutional buyers, private equity firms, and strategic acquirers that typical brokers don't reach. They also handle more complex deal structures and negotiations. Fees are higher, But for the right business, they can access buyers willing to pay premium prices for strategic fit. Effective marketing requires a balance between attracting qualified buyers and maintaining confidentiality. You don't want employees, suppliers, or customers learning about the sale prematurely, which could damage business performance and value. Your broker will prepare a comprehensive information memorandum, also called a sales memorandum, or IM. This typically includes an executive summary highlighting key strengths, detailed financial performance over 3 years, overview of operations and business model, information about market position and competitive advantages, details on premises and lease terms, employee structure and key personnel, growth opportunities, and reasons for sale. The IM is designed to provide enough information to generate serious buyer interest, while withholding identifying details until buyers sign confidentiality agreements. It might describe your business as an established cafe in Brisbane's inner north suburbs, without naming the specific business or location. Marketing channels include online business for sale platforms like businessesforsale.com and BizX, industry-specific publications and websites, broker networks and databases of qualified buyers, direct outreach to strategic buyers or competitors, and international buyer networks for larger businesses. The initial listing shows limited information, industry, general location, asking price range, and key metrics. Interested parties must submit basic information and sign an NDA before receiving the full information memorandum. Your broker screens inquiries to separate serious buyers from tire kickers. They'll verify financial capacity, assess buyer experience and suitability, and determine genuine intent before arranging meetings or site visits. Maintain strict confidentiality throughout the process. Many sellers make the mistake of telling employees or suppliers too early, which can create uncertainty and instability. Have a plan for when and how you'll communicate the sale. Generally, don't tell employees until a deal is unconditional and settlement is certain. Be prepared for the marketing process to take time. Depending on business size, industry, and price point, finding the right buyer can take anywhere from 3 months to over a year. Smaller businesses under $500,000 might sell within 3 to 6 months. Mid-market businesses $1 to $5 million often take 6 to 12 months. Larger or specialized businesses can take 12 months or longer. During this period, it's absolutely critical that you maintain business performance. Nothing kills a sale faster than declining revenue or deteriorating operations during the marketing period. Buyers will see recent performance trends, and any downturn will either reduce the price they're willing to pay or cause them to walk away entirely. When offers start arriving, evaluate them carefully based on multiple factors, not just price. Consider the offered price against your valuation range. Look at the deposit amount. Larger deposits indicate serious commitment. Review the proposed settlement timeline. Can you work with it? Examine the conditions. Are they reasonable or overly onerous? Assess the buyer's financial capacity. Do they have funding approved or arranged? Consider any special terms, vendor finance requests, extended handovers, employment contracts. Your broker will negotiate on your behalf, but you make the final decisions. Don't be offended by initial offers below asking price. That's normal in negotiations. Counter offers should be thoughtful and justified. Explain your reasoning rather than just stating numbers. Once you accept an offer, the buyer enters their due diligence period, typically 14 to 30 days. During this time, they'll investigate everything about your business. Be prepared to provide extensive documentation, complete financial records, tax returns, and BAS statements, bank statements, supplier and customer contracts, employee agreements, lease documents, licenses and permits, equipment lists, and valuations, intellectual property documentation. The buyer will likely engage accountants to verify your financial claims, lawyers to review contracts and legal standing, and possibly industry specialists to assess operations. Be cooperative and responsive. Delays in providing information create suspicion and can kill deals. However, also protect yourself during due diligence. Have buyers sign comprehensive confidentiality agreements. Limit access to sensitive information until necessary. Don't let due diligence disrupt business operations unnecessarily. Keep the process confidential from employees and customers as long as possible. Be honest about any issues or problems. If there are challenges with the business, disclose them proactively rather than waiting for buyers to discover them. Undisclosed problems discovered during due diligence destroy trust and often end negotiations. Disclosed issues can be discussed, explained, and potentially adjusted in price or terms. Buyers often come back with requests to renegotiate based on due diligence findings. Some of this is legitimate. They've discovered genuine issues that affect value. Some is negotiation tactics, trying to reduce price after the fact. Your broker will help you distinguish between the two and respond appropriately. If renegotiation requests are reasonable and based on genuine newly discovered issues, consider them carefully. A small price reduction might be preferable to starting the process over with a new buyer. However, if the buyer is being unreasonable or using due diligence as a tactic to dramatically reduce price, be willing to walk away. As settlement approaches, work closely with your lawyer to finalize all documentation. The contract of sale should clearly specify all assets included and excluded, the exact purchase price and allocation across asset classes for tax purposes, settlement date and location, any vendor warranties about the business condition, restraint of trade terms preventing you from competing, and the handover period and training commitment. The restraint of trade clause is important from the buyer's perspective, but also affects your future plans. Typically, these prevent you from starting or working in a competing business within a certain radius for a specified time, often 2 to 5 years depending on business type. Negotiate these carefully to ensure they're reasonable and don't overly restrict your future opportunities. Plan for settlement day logistics. You'll need to hand over keys, access codes, passwords, supplier and customer contact information, employee details, equipment manuals and warranties, intellectual property rights and domain names, and social media account access. Create a comprehensive handover checklist to ensure nothing is forgotten. Most business sale agreements include a handover or transition period where you remain involved to train the new owner and facilitate a smooth transition. This typically lasts 2 to 6 weeks depending on business complexity, though some arrangements extend longer. Take this period seriously. The buyer's success is partly your responsibility, and their success validates the price they paid. Be generous with your time and knowledge. Introduce them to key customers, suppliers, and employees. Walk them through daily operations, seasonal variations, and problem-solving approaches. Share insights about customer preferences, employee strengths, and market dynamics. Document everything during handover. Don't assume they'll remember everything you tell them. Provide written procedures, contact lists, and operational notes. The better the handover, the more likely the business thrives under new ownership. Be prepared for an emotional transition. Many sellers underestimate the psychological impact of leaving a business they've built. It's common to feel a sense of loss, questioning whether you made the right decision, or anxiety about what comes next. This is normal. Give yourself permission to feel these emotions while also being excited about your next chapter. After handover concludes, resist the temptation to stay too involved. Unless you have an ongoing employment arrangement, let the new owner run the business their way. Continuing to interfere or offering unsolicited advice can create problems and confusion for staff and customers. The restraint of trade clause means you can't compete directly, but you can certainly pursue other opportunities. Many successful business sellers become serial entrepreneurs, consultants, investors, or simply enjoy well-earned retirement. Whatever you choose, selling your business successfully provides the financial foundation for this next phase. Selling a business in Australia is a significant undertaking that requires careful preparation, strategic marketing, skilled negotiation, and professional guidance. Start preparing early, ideally years before you plan to sell. Get a professional valuation to set realistic expectations. Choose the right broker or advisor to represent your interests. Maintain business performance throughout the marketing process. Be honest and transparent during due diligence. Negotiate thoughtfully on price and terms, and commit to a thorough handover that sets the new owner up for success. Done properly, selling your business should be a rewarding experience, financially, professionally, and personally. It's the realization of the value you've created and the beginning of your next adventure. For more insights on buying and selling businesses in Australia, visit offmarketgroup.com.au.